Welcome to the Rose Show podcast.
Thank you so much for joining us today. Today I'm here with Peter Boockvar, CIO of Bleakley Financial Group and editor of the Boock Report. What a great name. And you're also a CNBC contributor, and we see you quite a bit on CNBC, and we love your valuable insights. So let's get started. How you doing today, Peter?
Great, thank you. Looking forward to a long weekend.
Oh, we are as well. So happy to meet with you today. So, Peter, I loved your quote from, I think it was 2014, where you say QE put beer goggles on investors' attitudes regarding the perception of risk in asset prices. So, Peter, tell us, are you seeing that similar phenomena having gone on recently as well?
Well, the beer goggles really were created by zero interest rates and QE, and that it's that monetary policy that creates the beer goggles that makes every investment from an investor standpoint look good. And it's not until QE goes away or turns into QT, or rates start to rise off zero, that those beer goggles start to clear up and investors become a lot more discriminating about what they buy and how they view things. So now we're sort of in that clearing up phase that really started in at the peak euphoria in 2021, and we've been seeing obviously a much different macro environment where and not everything works anymore in investing.
Absolutely. Do you think we have more to go? Is there going to be more of a re-rate and a perception change in risk, or do you think we are about where we're going to be remaining?
I think because of the likelihood that interest rates are going to stay high for a while, maybe not as high as they are now, but much higher than what investors have been accustomed to. I mean, when you think about up until last year, the only thing for 15 years investors were used to was QE and zero rates. So anything with a plus sign in front of it with regards to interest rates, let alone real interest rates, is a different macro environment. So I still think that there are many more chapters to this book to be written, and that in fact we're not even close to being done with this sort of reset.
Absolutely. And I also use that word reset. And I mean, we got our PCE report today, and we see inflation. It's still highly elevated. I mean, still rising 0.4% month over month. I think the read was 4.7% year over year for core, and that's significantly elevated. And we have a very tight labor market as well. And, that income growth seems to be fueling that nominal spending, which is just maintaining this persistently elevated inflation. What are your thoughts on all that? It is decelerating, but what do you see with what's going on with inflation and the labor market and the lower growth?
Well, with inflation, it's very important to split it up into two. When I say it's, meaning let's just use the CPI, where you have goods price inflation and you have services inflation. And just for some perspective, because I think it helps really distill better where we are today, is in the 20 years leading into COVID, goods price inflation, core goods prices, so ex food and energy, averaged to zero. And that's because of just-in-time inventory, technology, cheap labor around the world, particularly out of China. It was always services inflation that always propelled aggregate inflation higher. The 20-year average in those pre-COVID years for services inflation ex energy was 2.8%. So you merge them together, you get volatility in food and energy prices, and that's why for a period of time we averaged 1 to 2% inflation. So of course, with COVID and all the supply chain challenges, it was impossible to sustain zero goods prices, and that obviously went vertical. So now we're sort of on the backside of that. I actually think that now that we've basically fallen back to zero, we've bounced a little bit above that on a year-over-year basis, that goods prices, that fallback have probably bottomed. But on the other hand, services inflation, which is always persistent, is never transitory because of rising rents, medical care, insurance, tuition, going to a baseball game, going to a concert, going out for dinner, things always seem to get more expensive on the services side. But so now you have a situation where services inflation within the government statistics are overstating the rental component, which is a big chunk of that service piece. So inflation, as the year progresses, will continue to moderate, and maybe we do see a 2 or 3 handle by the end of the year. But that doesn't mean, okay, we're just back to where we were because we have a 2 handle. The question is when you look out to 2024, even the year past that, is where is inflation going to settle out at? Is there a new inflationary environment that is there a new dynamic, a new structural change that has taken place in today's environment where we're just going to go back to 1 to 2%, the salad days, and the Fed will be able to slash rates back to 0 in any recession and QE and so on. And I think those days are over. And if anything, while inflation may dip to 2-ish, it's going to be 3 to 4 is going to be the new normal with inflation when you merge goods and services prices together. Now, what that means for wage growth, speaking of the 20-year average pre-COVID for wage growth, it was about 2.5%, and now we're running at about 4.5 to 5, which is good from the sense of we need higher nominal wages to offset the rise in people's cost of living, but that's well above the pre-COVID pace. So it's going to be really hard to get inflation on a sustainable basis, not on a month here, a month there, but on a sustainable basis to the 1 to 2%. Now, with respect to overall consumer spending, to finish out your question, we're seeing some real divergences in how people are spending their money. There's been a much more of a focus, and Dollar Tree, it's actually $1.25 tree now, said that in their earnings call that their customers, now we know the type of customers they have, are much focused on needs and not wants. Even Costco talked about the reduction in spending on discretionary items like jewelry, indoor furniture, electronics. We've heard from other retailers that consumers are spending more on food and beauty and drugstore type stuff. So there's a clear change in people's attitudes. And I do think that, and this is important, that you had slowing in the beginning of the year, but that slowing accelerated at the back half of March into April and even into May after SVB collapsed and we saw some other bank failures. So there's been sort of a 2-part economy, pre-SVB, post-SVB, and I do think that this post-SVB weakness will continue as the year progresses.
Excellent points there. I want to first bring up the point about this new level of inflation, about 3%, maybe up to a 4% range. And I have been reading about that. I know Deutsche Bank said once inflation's over 5%, it could take up to a decade to come back down. Do you think that this inflation is entrenched and that we will have to be in this new level, like you said, with the services plus these goods? I know thank you for explaining the different parts. Do you think that we will remain at this higher level for some time and eventually come back down because it takes time to go through this process? Or do you think that we may stay at an elevated level due to all the recent occurrences?
Well, in just trying to figure out the next year is hard enough. So just the next few years, when we look to the structural drivers of what kept goods prices as averaging 0 for a few decades. And I mentioned just-in-time inventory. When we think about if you're going to run a manufacturing facility, what is just the most efficient way to do it? Is if you're going to rely on a lot of suppliers, let's have what you need to come in onto the assembly line just when you need it. Therefore, you don't have to use up working capital, holding a lot of things in inventory. You can rely on your vendors to take a lot of that risk, and you run a very efficient sort of supply line. Well, I think COVID really disrupted that because I don't think that companies that when you look at an auto company, they relied on thousands of different suppliers. And do they really want to rely on that to the same extent? Not that they're going to bring everything in-house and become these vertically integrated monsters, but there's going to be more stuff on the shelves. They're going to have more days of inventory on their books and in their warehouses. So I think that that leads to more working capital needs, less cash flows, stickier prices. When you look at also low-cost labor around the world, which allowed people to go to Walmart and buy inexpensive things, a lot of that came from China, but there's no such thing as low labor costs in China. And while there are some diversifications of supply chains to Mexico, to Vietnam, to Thailand, for example, it's still at a quicker wage picture than what we've seen before. Now, technology is always going to be a deflationary force, but it's been that way since the history of mankind. So that's not a new thing. Will AI be deflationary? Yeah, I'm sure. But like I said, technology's always been that deflationary force. And over time, it will continue to. We're just trying to figure out where's inflation going to go over the next couple of years, because then that has a direct influence on where interest rates go. So all you need is goods prices to rise maybe 2 to 3% rather than 0. And you combine that with services inflation that I said earlier persistently ran at around 3%, and potentially could be higher because now wage growth is more persistent in the US, and that the profit pie, there's a bigger slice now going to labor. And I think that can continue. That can also lead to stickier and potentially higher services and prices, because we know the service sector is much more labor intensive than the manufacturing sector. So while 3 to 4% inflation is much better off than the 9% that we saw last summer, 3 to 4 means that the Fed can't go back to 0 when it comes time to cut interest rates. It means that interest rates are going to be structurally higher for the next couple of years, which is a much different dynamic than what we've been used to. And I'll finish it, pass it back to you, is that our economy for the last few decades has been very dependent on borrowing to drive economic activity, less so on savings. Well, now that borrowing costs more, which means we need more savings in order to drive economic growth from here.
Excellent point. There's so many excellent points of what you just said. And, I think it is a healthy dynamic to have our money actually have some interest, a savings economy. We've always been into spending. It's almost like they just raised us to be a consumerist and continue to spend because money was basically free. We had basically negative rates, free money, and our money didn't have any interest in the bank. So it's changing now. Risk-free rates are in the 5s, much higher than the S&P earnings yield. We're actually able to have a return on our money in the money market or in T-bills, rather than having to take on risk in the market. So that perception has changed. You mentioned needs over wants. Absolutely. Beauty, I guess, is a need nowadays, along with medical and, all those essentials. I know energy is a very important component as well. Commodities, value. We're looking, fundamentals matter. And I always talk about that myself. I'm actually a CEO of a manufacturing company, and I've been in it since over pre-2008. And these are opportunistic times. I always talk about these are shifts in the way we do business, and we need to streamline, innovate. There's a declining productivity across the board, and automation is absolutely necessary in order to have efficiency. And you use that word. I love that you use that word and you brought that up, because this is like a year of efficiency. We need to become more efficient. However, with the war in Ukraine and with everything, with COVID, we had to have a high increase in our inventory levels because we didn't know when the supply was there. I had back supply chain bottlenecks, months for a lot of parts and supplies. So now we're maintaining more inventory levels, just in case that happens again. And, it's changed. The times are changing. It's a new regime in many ways. So, and I love that you made that point about pre-SVB versus post-SVB and about the bank, and that's a critical point, because before March, we were thinking rates were going to keep going up. We have persistently elevated inflation, labor market is tight, and the Fed would have to continue tightening. Since this banking crisis occurred, which to me is a symptom of all the free money, negative rates, and sovereign bond bubble. And, because of all that, I think now we're saying, okay, we're going to be higher for longer, not as high as we thought, but longer, and it's going to remain at this level. What are your thoughts on what you think the Fed will be doing in this June meeting and going forward, looking at all the data, including this post-SVB?
So interestingly, and I think mistakenly, since SVB went down, the Fed has raised 2 more times, so 50 basis points in total. And according to some estimates, the credit contraction as a result of that is the equivalent of 50 basis points of rate increases. So between the banking system and the Fed, we've seen essentially 100 basis point rate increase after the bank failure. So that's a lot of tightening on top of what all of a sudden became a pretty fragile economy. So I think that was a big overstep that the Fed has conducted here because of their focus on rear view mirror analysis. But also, it's important to understand that the Fed doesn't get yet is that now that we've gotten to this 5% level, now that they have finally gotten interest rates above the level of inflation, so we have positive real interest rates, because we went so many years, 15 years of essentially zero rates, and then you go up in a straight line higher all in 1 year, just by keeping rates at a high level after so many years of this, every month, every quarter that progresses from here is a continuous form of tightening. And that is because of all the debt that was taken on pre-2022 that comes due this year and next year is going to have to get refinanced at a much higher interest rate than the loan that is maturing. Therefore, you either can pay it off, or if you have no choice but to refinance, chances are you're going to be then all of a sudden allocating more cash flow to your interest expense, whether you're a household that has an adjustable rate mortgage that's coming due, or you're a business that has the loan coming due, or if you're a business that just has had floating rate debt for the past 18 months, and every month you're getting screwed because your interest costs keep going higher and higher and higher. And that is not an event that happens all at once. It's something that just chips away at economic activity as it sort of takes money and from the borrowers to the creditors and leaves businesses and households with less free cash, call it.
Absolutely. Well said. I'm glad you mentioned that point. I was actually going to bring up the margins being compressed. Now, in corporate earnings, my opinion was that it was better than expected because they were pretty negative and they revised lower. However, in my opinion, they weren't that great. They wasn't that good, and margins are compressed, and I think it shall continue. And exactly as you said, there's a higher cost of debt and capital, and they're going to be refinancing or they're going to be getting those capital infusions, especially the smaller caps, smaller businesses that need that constant refinance to get capital. And it's going to be at a much higher rate and higher cost. And that's going to affect those already compressed margins. And if we see demand coming in, as we've seen the pattern of retail softening and people choosing needs over wants, discretionary spending coming down, that top number is going to come down as well. And that was holding up sales because of increased pricing. So I think, my opinion, that, a recession or even stagflation, which is a lot of talk about stagflation, is in the future, in the near term future. We don't know when. Peter, do you believe that we need a recession to help bring down this persistently sticky, elevated inflation?
Well, it's always a great question because theoretically, you think yes, in the sense of you want to reduce the demand side, and that sort of recalibrates the supply-demand equilibrium at a lower price. But it gets more complicated than that, because if you think about, there's also the supply side of things. If you need more supply of things to create lower inflation, well, by sending us into recession with higher interest rates, you don't encourage the manufacturing of more things, and therefore more supply that can help fix inflation. And I mean, to me, the epitome of stagflation right now is what is going on in the housing market. It's right now the definition of stagflation, because monetary policy has thrown the housing market upside down again. They did it in the mid 2000s, of course, and they've done it again because they've essentially trapped people in their homes via low mortgage rates that a lot of people have, where 90% of mortgage holders out there have an interest rate below 5%. 70% have a rate below 4%. And unless you really have to move, and maybe you don't want to move, you're not really forced to move if you don't feel like it, because you got this low mortgage rate, and why trade it in? So you have this dearth of supply on the existing home sale side that is preventing prices from falling enough to mitigate the doubling of mortgage rates. So you have what you would think would have been a sharp decline in home prices with the doubling of mortgage rates, and we've seen nothing of the kind. So not only are borrowers who are going to take out a mortgage having to pay 7% instead of 3.5%, they're doing that for a home that is 40% more expensive than it was a couple of years ago.
Yes.
So that and that has dramatically slowed the pace of transactions. So if you look at existing home sales, they're near the lowest level in a few decades. If you look at the mortgage application data every week, the purchase component is at the lowest in a few decades. Now, new home sales are trying to fill in sort of that supply gap. Home builders are doing very well here, sort of taking market share from a lot of the smaller builders that are having more difficulty accessing credit. But still, in the aggregate, the overall level of housing transactions is down a lot. And that means that for every home that's not turned over, for every home that is not bought and moved into, there's less carpet that needs to be bought. There's less paint that needs to be bought. There are less handymen that need to do renovations when you move in. The NAHB, the National Association of Home Builders, estimates that housing all in, including real estate brokers, renovators, contractors, everything, could be up to 15 to 18% of GDP. So that's where I think is a perfect example of a stagflationary situation. But it's not all like that. I mean, there are going to be some examples of companies that over inventoried, like we saw in late fall into the winter of last year, where Target and Walmart, they all talked about they had excessive inventory, but a lot of that had to do with they didn't want to repeat the COVID trouble. So they all over ordered. And once things started to ease, they realized they had too much stuff. At the same time, consumers were switching their spending from goods to services. But you are seeing Restoration Hardware, their earnings call, they said some of their older product they're going to be discounting in order to clear out space for the newer stuff. But I think in the aggregate, it's just inflation that'll just be more persistent and more of a thing. Whereas pre-2022, or I should say pre-COVID, it wasn't much so.
Exactly right. I'm glad you mentioned the housing, and that pattern that seems to be persisting, that home sales are down. However, home prices are still elevated in many areas, and depending on where you live, and of course, real estate's very regional, but in the New York City metro area, which is where I live, we have historical low inventory, that prices are actually much higher than they were before COVID. I mean, significantly higher. And, I think you said it right. The Fed has trapped all these people who are just holding on to these. They locked in at these low rates, and they're just holding on. And it's almost like an artificial cycle that now people aren't selling, even if they want to. They're just like, why would I pay for another home at, my, premiums could be like, the rate prices could be almost double for, because of that higher rate. My concern is, I don't know if this is a concern for you as well, but that, we're seeing a slowing down pace in hiring, and that, as profitability is more compressed, businesses could start laying off significantly. And as people lose their jobs, I don't care if you're locked in a, 0% mortgage, you can't pay. If you don't have a job, you can't pay your bill. So at that point, if we get to that point, we could see a flood of homes coming out on the market. Plus, a lot of these third and fourth homes that were purchased for Airbnb usage probably will be vacant if we see, people declining on their travels. We were all locked up during COVID. So everyone bought up vacations and travels in 22, and they're traveling, they're out and about. But in the next 6 to 12 months, I'm sure they're going to be cutting back on that as needs are preferred over wants. And so those homes stay vacant and there's no cash flow. They're going to be forced to liquidate and sell. So we could see a big flooding of housing coming on the market all at once. Do you think that could be a possibility?
Yeah, that very well could be. And while it would be obviously a result of people losing their jobs, it would help lower the price of many homes. So that would be a good thing too. I also think, to take it one step further, is we should continue to see decelerations in rental growth as well.
Yes.
So for those that can't afford a home, it's been very expensive to rent. Well, we have a ton of multifamily supply coming on stream over the next year plus that could help further the declines that we've been seeing this year after double-digit rental increases. One step further from that, though, is there are essentially no multifamily projects getting started right now. Is anybody that had a business plan is putting pencils down because of the plateauing of rental growth at the same time of the sharp jump in the cost of financing. So after this supply glut, we're going to go right back to a supply constrained market, and rental price increases are going to go straight back up again. So it's just another example of how monetary policy has literally turned this most interest rate sensitive part of the economy upside down.
Absolutely.
And not only that, it's made living unaffordable for many people. And it's really unfortunate.
Absolutely right. Excellent points. Now, Peter, what would you do if you were Powell? I'd like to have your input. You seem to have fantastic insight. What would you do? What do you think the Fed should do, or what would you do as Powell?
So I would stop raising interest rates right now. I wouldn't necessarily say, oh, I'm done, because no one knows how things will play out over the next couple of years. But from a risk management standpoint, from a prudence standpoint, when you see some bank failures, when you see deposits leaving the banking system to the extent that it has over the past couple of months, when you see tighter credit standards from the banks and also less in demand, a risk manager would say, take a step back, call timeout. Let's see how this plays out. So that's the first thing you need to do. Now, I do think interest rates should always be above, or at least at, the rate of inflation. The whole negative real rate environment has been, in retrospect, a complete disaster, causing booms and busts. We saw, like I talked about, what it's done to the housing market. I think QE was a terrible idea to the extent of where it's gone. Negative interest rates I call the dumbest idea in the history of economics. Agreed. So I think they should continue to shrink their balance sheet as much as they can, because we don't want the Fed to be so dominant of a footprint within the bond market. We do want interest rates. We do want interest rates at a certain level above the rate of inflation. But I think also important is a central banker that needs to be a parent to tell the kid, sometimes life is tough.
Yes.
And every time you want more candy, that doesn't mean you're automatically going to get it. And up until last year, the Fed always gave the kid what they wanted, the kid being the
Yes.
markets. And there needs to be a continuation of this tough love. Now, to say what Powell should do today going forward, the mistake was made before he started raising interest rates. So it's the aggressiveness and the speed of the interest rate increases that causes the problem. So I would have, if I was the Fed chair, I would have started hiking well before he did. Therefore, it would have been more of a measured rate of increase with respect to interest rates, not going vertical. When you think about the last couple of years, inflation and the CPI index had a 5 handle on it in May 2021.
Mm-hmm.
Since then, through the end of 2021, the Fed added $1.2 trillion to the balance sheet, and they didn't start raising interest rates until 10 months later. That is where the error occurred.
Yes.
Now they're compounding it, not necessarily by getting interest rates to this absolute level. It's just the speed at which they've done so.
Absolutely right. I also believe they should have started a little earlier, but I guess we want candy, and I guess they wanted to be the loving parent that just gave us what we wanted. So I love that analogy.
Well,
Excellent.
they also, they always have good intentions. They said, you know what, we are 5 to 7 million jobs below where we were pre-COVID, and we want to stay accommodative to get these people back to work. But they didn't really think big picture, because while, yeah, we want those 5 to 7 million people back in the office, with inflation, they screwed the 150 million households that were already working. So the trade-off was not very even-handed, and there was so.
And they were also
That's
saying
why they
that
overstayed their welcome.
Yeah, and they also were saying that it was transitory. And they had been saying that inflation is transitory. And, I think that the banking crisis, the sovereign bond bubble. Now, I know you've spoken about this sovereign bond bubble. Could you tell us more of what you think, how that's going to play out with these rate hikes and those sovereign bonds?
Well, to define this bubble,
Please do.
the peak of that bubble was when we had $18 trillion worth of negative yielding securities around the world, basically in Europe and Japan. I mean, a negative yielding bond is the epitome of a bubble, in the sense that central banks turned what was once an asset, owning a bond, into a liability because the owner actually was paying out on what they owned. So that way, and it was the ultimate hot potato in order to make money owning a negative yielding bond, because you had to sell it to some other person who would pay a higher price for it. So QE, zero, and negative interest rates created this epic bubble, in dollar terms, the biggest financial bubble we've ever had. And inflation was always going to be sort of the kryptonite that was going to be the pin that would pop it, which is, of course, what we've seen. So this doesn't just sort of fix itself in a couple of years. This is something that plays out over a many-year time frame in terms of the aftermath and the deflating of it.
Exactly. This will take time. Do you think that more small and regional banks will fail as a result of this due to their illiquid assets? And do you think there'll be more bank runs? I mean, in my opinion, I don't see why anyone would keep their money at the smaller banks. I mean, I'm banking at, Chase, JP Morgan. But do you think that that's going to be a continuing phenomenon that's going to play out for the next 6 to 12 months or maybe longer?
There will be more, and just to make a point on that,
Yes.
what makes the banking situation today unusual compared to previous historical bank failure / recessions is, historically, the economy, a bank in the expansion lends out a lot of money, and then it's a recession that then leads to rising delinquencies, then bad loan books, and failed banks. This time around, before the economy has gone into recession, it was the vulnerability in their balance sheet with respect to their long-term bond holdings.
Yes.
And it was the widespread between government treasuries and their deposit rates that led to a bank depositors leaving the bank. This is before the credit cycle is really going to take place. So you've created this unusual vulnerability in the banking sector before the recession. Now we have to look forward to, unfortunately, a decline in commercial real estate, particularly office, and other rising delinquencies in subprime auto or credit card, or then businesses that aren't going to be able to make it. So that fragile state, combined with what is now on the cusp of a downward part of the credit cycle, will lead to more bank failures. Hopefully, nothing systemic, but you will see some more failures. You will see some more mergers. But I think in the aggregate, I'm more worried about what that means in terms of credit extension. Is that most loan officers right now are focused on controlling their balance sheet. You can't get a bank loan now in real estate because all these banks are trying to shrink their real estate books, not expand them. So to me, that is going to be, there are always bank failures. There always has been, and there always will be. And somehow it always, outside of 08, where it was obviously the biggest ones, these bank failures will be obviously not the bigger ones. It'll be the smaller ones, but they'll merge and we'll have more consolidation. But the real economic impact is what that means for credit. Now, just to quantify, in the US, the banking system accounts for about 20% of all lending, with the balance being non-banks and the capital markets, whereas in Europe, it's about 80% of lending is reliant on the bank. So a bank credit pullback is not disastrous for the economy, but if we're seeing it also happen in the other parts of the lending environment, then in the aggregate, it matters. Now, you'll talk to a non-bank lender, a private equity credit fund, and they'll say, oh yeah, we'll replace the banks. Well, great, but you're going to charge me 13% on that loan for it. So yeah, if I'm in desperate times, I may have to pay 13%, but that's not really going to help my business.
Absolutely not. And that cash flow will be significantly reduced with that higher cost of debt and capital. Excellent points there. I think there are going to be less banks and more branches. And it appears that banking oligopolies may be the path we take. And, these smaller banks will get acquired.
But that also, they got flooded with deposits because of all the QE.
Exactly.
So the Fed has blood on their hands too, with what's going on with a lot of these banks, the flood of money that went into them, the money that's now leaving them, forcing them to take duration risk in order to get some return. I mean, it's all twisted.
Exactly. It's a very confusing macro landscape. And I think you mentioned the point that what we're seeing right now is usually in the trough of a recession rather than a pre-recessionary period. We have massive debt. I think we're at the highest debt levels and our deficit, and there's this continued spending. And a concern that I have is that even if we weren't to add more debt, the amount of debt we accumulated during COVID puts us at the point where, do you think that the central banks are going to be forced to continue printing money?
If they lose control of long-term interest rates, they can tether short-term interest rates to the Fed funds rate.
Yes.
If they lose control over long-term interest rates, which they possibly can, I can't discount them not, then they would be in a tough situation where, do they start debating yield curve control? Do they start saying, okay, well, QT is going to end and maybe we need to start doing QE again? That's a high possibility, but not until they lose control of long end rates. Now, long end rates have obviously risen along with short rates. Well, obviously short rates are much higher than long rates. But if the 10-year yield, for example, when I say lose control, I'm talking about a 10-year that goes to 4.5 to 5 plus. That creates a big problem for the Fed. That would then force them to maybe do something. But once they go down that rabbit hole, then that creates its own potential problems, because what happens to the US dollar if the Fed starts ramping up QE? I think it goes much lower, which then it probably exaggerates inflationary pressures. So we're going to have higher inflation, the Fed doing QE to contain long. I mean, it's really, when you think about the possible outcomes, and we don't know how it's going to play out. But when you think about the possible outcomes, there are a lot of messy outcomes.
Absolutely. And that's why it's a confusing macro environment here. We don't know where the 10-year will go, but there is a very high possibility it could go over 4 and 4.5, like you said. And then at that point, how are they going to tackle this massive debt and spending? And then we go back to QE, but what if inflation is entrenched and we still have persistently elevated inflation? What are we doing at that point? And that's really very concerning. What are your thoughts regarding investments, the markets? It appears to be a disconnect with the markets rallying. I mean, maybe they're rallying on this debt ceiling deal being done, which is not a surprise. I mean, we know through history there's always a deal. It's not a surprise. But what are you thinking regarding risk going forward in the markets? Are you bullish on any sectors in particular? Are you looking at alternative investments?
Well, right now we have 2 stock markets. We have one that's AI based, and then there's everything else.
Yes.
So AI has become its own asset class in terms of investing. Those are the only stocks that are going up, and then you have everything else. But we have to keep in mind that the creators of this new iteration of AI, I see new iteration because AI has been around for decades, many decades. Search itself is AI because it's gathering information that's out there, and it has been for a while. So you have the companies that are being rewarded in the market for AI, but the market has sort of forgotten that the beneficiaries of AI is everybody else, because they're the users of it. And if the new iteration of AI is going to be successful, it's going to be because they make everybody else more productive. And the ability to do things in 10 seconds instead of 10 hours, if it comes to writing a paper or a consulting assignment for somebody. So they're not rewarding the users of AI that are going to benefit from it, only the sort of producers of the picks and shovels of it. So that is not a sustainable situation. And also, not just that, and putting aside AI, you look at Google and Meta, for example, they're in the advertising business. Their customers are a lot of small and medium-sized businesses. Well, small and medium-sized businesses are not increasing their advertising spend right now. They're focused on trying to manage a challenging economic environment. Microsoft sells, and I'm not just necessarily picking on these companies, I just want people to think about buying a few stocks and nothing else. Microsoft sells a lot of software and hardware to the rest of corporate America. Well, the rest of corporate America right now is dealing with a challenging macroeconomic environment.
Yes.
So things need to be reconciled here. Either the rest of corporate America catches up in terms of business and stock market performance, or the piling into 6 or 7 stocks is just unsustainable. I think it's unsustainable, but it is what it is. I invest through the lens of a value investor, and I'm not having much fun of late buying value stocks because, again, everyone's piling into just a few of the winners that are getting more and more expensive. But I still like energy stocks. I still think that there's a growing sort of chasm between supply and demand that's going to build over the next couple of years. They're cheap. They pay good dividends, a lot of them. Still bullish on precious metals. I do think that there's still a bunch of deep value stocks that you can buy in the US that are being left for dead here. And geographically speaking, I'm pretty bullish on Asia. I think that the China reopening, while it's been very spotty and it's been mostly consumer-led and travel and leisure, I think having the Chinese economy open, 17% of the world's population, is good for the entire Asian region. You can play that through owning Japanese stocks, Singaporean stocks, and even companies that are plays on the Chinese tourist, and the Chinese tourist was a major spending powerhouse pre-COVID. They spent $250 billion a year traveling and buying stuff whenever they went abroad. And I do think over the next year, that Chinese tourist is going to be a major player again in world tourism. So there are pockets to buy. I do
Mhm.
think that the investing landscape, generally speaking, is very treacherous because of this higher rate environment that we're in. I mean, just over the past month, the market's getting more expensive as
Mhm.
the economy is slowing further and interest rates are going higher again. So that is not necessarily consistent, and something's going to have to give there. And I think it's going to be the stock market that will give more than the others giving to the stock market.
Exactly right. I think we're on the same page with that. I think challenges bring forth opportunities, and there's always some pockets here and there where we could find value. I love that emerging markets and global macro and Chinese, Japan. I love those sectors. Very interesting. I think there's significant growth over there. I do believe that gold is sometimes under allocated because we've had such free money for the past like 15 years, and you've been able to just throw money into assets, into equities, and they've done very well. And it's changed the perception of risk. And like you said, the beer goggles, our attitudes were different. And I think gold has its place in inflationary environments as well as deflationary in the tail environments. So I think gold is very important to be part of a portfolio, and depending on the person with the amount of the allocation. Are you looking at alternative currency or global reserve assets such as Bitcoin? Are you interested in anything like that?
So gold is sort of our alternative currency. When you think about Bitcoin, the creation of Bitcoin is really the foundation of the bull case for gold as well. Let's
Mhm.
own something. Now, gold is not as finite in the sense that Bitcoin is to 21 million coins,
Yes, don't have
but
inelastic supply. Mhm.
gold's really hard to get out of the ground. And gold supply is only growing about 2% a year, which is basically going to be the growth of the Bitcoin's mine for a bunch of years. And okay, so let's own something that's can't be printed by central banks. Let's own something finite in nature,
Mhm.
that's out of sort of the financial system. Well, that's a definition of gold. And gold's got 5,000 years of a track record. When you've been alive for 5,000 years, you've seen a lot. When you've been around for 14 years, you've seen a lot less. So that's not to say that Bitcoin could have a 5,000-year run from here. We're just more comfortable owning gold for the same reason that others may own Bitcoin. Now, I don't think one replaces the other. I think they can complement each other, but I think it's to each its own, to each their own on what you want to own. If you want to own sort of that sort of non-fiat currency asset class, which we here want to own.
Absolutely. Excellent. Well said. I love your perspective, Peter. You're very brilliant, and I love your thinking. So yeah, I agree with you. Gold. I love the time tested. It's been around for thousands of years, and it's solid alternative currency. You talk about AI. There's like a 6 or 7 stocks there. Does this sort of remind you of the 2000 bubble, or just a bubble overall? Do you think that this could be setting up to be the AI bubble?
Well, it is in the sense that the market cap increases relative
Get
to
NVIDIA.
the
Oh,
business potential of the next couple of years is quite wide. So there is, let's just buy the hype and we'll see the details later.
yes.
NVIDIA is actually selling stuff to power all the future AI. But if you're Microsoft and Google, it's really hard right now to quantify the AI improvement to your business. We don't know yet. We don't know whether it's just going to be an add-on to their software, that it's just going to make Bing a little more efficient than it once was. Because that's what software is. Every couple of years, there's a new iteration of software because it embeds more tools. Well, AI is just another one of those tools. Now, this is potentially hugely disruptive when you can just type in a question and it spits out something in seconds, of course, that would ordinarily have taken somebody hours. There are a lot of productivity benefits for sure, but the market cap gains have been pretty heady and impressive relative to the uncertainty about where this goes. And I can promise everyone that NVIDIA is not the only one that's going to be making AI-powered chips over the next couple of years. There's going to be other competitors to NVIDIA. So we just have to keep that in mind when we put $1 trillion valuation on it.
Exactly. And that's it. It's a very highly valuated stock, very high valuations. And there should be, if this is the end all technology, AI, I'm sure there'll be plenty more competitors coming out very near term. But yes, exactly right. Now, we've had this sideways market. Many have said we've gone nowhere in the past few months. It's been, pretty 4,000 to 4,200. People are saying 4,300's resistance. We shall see what happens. But in your opinion, do you think that it will most likely get worse before it gets better?
I still think we're in a bear market, and the bear market's not over. And it's obviously difficult to see how it's going to play out with the Fed so influential and these big cap tech stocks that are 30% of the S&P being so dominant, and how this plays out. But as long as interest rates are going to stay high for a while, like I said earlier, there's more chapters to be written here in this story.
Absolutely right. And I agree with you on that. I think that, many people say, the bear market is going down and the bull market's when we go up. I think when there's so much uncertainty, and I always say the only certainty these days is uncertainty. To me, that signals a bear market, because we really don't know where we're headed. And, excellent point you made about the 10-year. We don't know where it's going. Short term, yeah, the Fed has control over that, but we don't know where the 10-year may go. And if it does go in the 4.5 or higher range, then there's some very serious concerns there. Thank you so much, Peter, for taking your time today. Please tell us about the Boock report. We're dying to know more about that. I know that's where you provide your excellent insights about what occurs with data, economic data, and macro, but tell us more about that.
So it's just a place where I write daily on things going on and put in my 2 cents. People can check out the product at Boock Report, BOOCK report.com, and they can trial it if they're interested, and they can subscribe thereafter. And it's just a way for me to collect my thoughts on a daily basis, write it, and it helps me become, I believe, a better investor.
Absolutely.
For our clients.
Yes, and I think everyone who reads it will as well. So thank you so much, Peter, CIO of Bleakley Financial Group. And how long have you been in the markets?
For about 30 years.
Wow.
So
you
have my scars on my back from 30 years of market experience.
I have to tell you, in these times, many have a recency bias, and they've only experienced the fast flash recession of 2020. I don't even think we could call it a recession. It was so fast. It just happened so quickly. And then even 2008, there was a quick remedy. But, it was a difficult time. But I think seeing other bear market cycles and what happened in 2000 really changes our perception and understanding going forward. And we need to proceed with caution. So thank you so much, Peter. And of
course, my pleasure. I appreciate having me on.
Absolutely. Thank you to all the listeners.
Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon. All investment, real estate, financial, legal, and tax opinions expressed by Rosanna Prestia or on The Rose Show should not be relied upon as professional advice and are intended to be used for informational purposes only.